Today's webinar, Creating Shared Value, the Key Role of Corporate Social Investors, is hosted by AVPN in partnership with the European Venture Philanthropy Association, EVPA. Let me say how delighted we are to have you all in the room. My name is Roshni, and I'm the Knowledge Director at AVPN. I will be your host this afternoon. AVPN is a network of social investors and resource providers with over 600 members across Asia and the Pacific. Our mandate is to move capital towards impact by holding convenings such as the one today. Today's session will start with an introduction from AVPN and an overview of the corporate initiative by EVPA. This will be followed by presentations from Trafigura Foundation and Incofin. The webinar will conclude with the opportunity for questions and answers with the speakers. A few housekeeping announcements before moving to the program proper. First, please keep your microphones turned off. There is no need to turn on your video camera at any point during the session. Please use the app version of Adobe Connect for a better user experience. If at any point you get disconnected, you can reconnect using the same URL code that we sent you. If you have a bad connection, try to log out and then log back in. Hopefully, this will improve it. If you have any queries, please use the Q&A box that you see in your screen. We can all give it a try by writing where you're from. Please note that during the presentations, your questions will only be visible to the AVPN team. Rest assured that we are monitoring this behind the scenes and will address as many of the questions as possible when we get to the Q&A portion of this webinar. Finally, do participate in the polls that we will share during the session. On to the program proper. We will first hear from Kevin Teo, Chief Operating Officer at AVPN, who will set the stage for today's webinar. Kevin, please.
Thanks a lot, Rosh. And for those of you in Southeast Asia, a very good afternoon to you. Good morning to our friends in Europe, Sophie, Caroline, Vincent, and Dina joining us on this webinar. As Rosh has mentioned, we have partnered with EVPA, the European Venture Philanthropy Association, on this program around corporate social investors. And EVPA, which started in 2004, shares the same founding chairman as AVPN, Mr. Doug Miller. AVPN itself was founded in 2011. And as sibling organizations, AVPN benefited quite substantially from early partnership with EVPA on their research material, on their learnings on building up the community of venture philanthropy and social investors. And we truly value this close partnership between both organizations. So Sophie and Caroline will expand on the corporate initiative in further detail later, but just some quick highlights that we know. It is a program with more than 100 corporates from 14 countries across Europe, and they have put out very interesting and relevant publications on corporate social investing strategies, as well as employee engagement programs. So please peruse the EVPA website to access these material. How we decided to partner with EVPA on this specific program is because of earlier conversations between their CEO, Steven Sernils, and our chair and CEO, Naina, on the importance of engaging corporates on delivering impact within Asia. As many of you know, the world is becoming more interconnected, with European corporations functioning in Asia, and Asia corporations having activities in Europe, and the importance of collaborating across these two spheres is more important than ever. Within the venture philanthropy family, there is also the African Venture Philanthropy Alliance and LatImpacto, our partner network in Latin America. And the ambition is to make this joint program a global initiative subsequently. Before we pass the time over to our speakers from EVPA, we would like to have a sense of who is in the room. So please do take the time to answer the poll question which you see on the screen now, which is looking to understand what is your role in relation to corporate social investing. You can see the options of corporate social responsibility, corporate foundation, impact accelerators within the corporate, and think about these as accelerator programs that support social enterprises or socially impactful businesses. Corporates can also start social businesses themselves or have shareholder foundations, and these are foundations that are created with the equity of the corporate entity. There is also the notion of corporate impact funds, and some of these are characterized as venture capital type funds within corporates that seek to not only deliver financial return, but also social impact. Okay, so thanks for responding to this survey. And interesting to see that we have a good representation on the social business dimension. Also, several of you have selected corporate foundation as the existing activity within your organization. And also quite a good number have said none so far, which is great. We look to share more with you and hopefully for you to pick up some good examples from today's webinar and be motivated to start something within your respective organizations. Okay, so I think we can move on to our first pair of speakers from EVPA. I'd like to welcome Sophie Faujour, who is EVPA's head of the European Corporate Initiative and country manager for France, and Caroline Heitmann, who is EVPA's corporate initiative manager. So we'll start with Sophie. Sophie, the floor is yours.
Thank you, Kevin. Thank you. Thank you. I was full screen. I wanted definitely to go to the right window. Thank you very much. I still have the music. I'm sorry, still have the music on the. All right. Let's go ahead. So thank you very much, and we're delighted to be here with our sibling organization, AVPN. So as Kevin said, EVPA is the European Network of Investors for Impact with 300 plus members and mostly foundation and impact investing funds. Out of these 300 members, about a third are corporate members, and we rapidly identify the need to develop dedicated resources for them. So in the next slide, you can see that indeed the corporate initiative help European corporates to engage in the search of most effective way to scale high-scale impact, leveraging strategically their company's resources. This is our mission, and the objective is that it becomes the norm by 2030. And we're happy to share with you some insights from this group of European members represented by the logos in front of you. Well-known multinational listed companies. You may wonder which internal teams we're talking to in those organizations. Are we talking to CSR team, foundations, social innovation teams? Well, actually, all of them, but more specifically, those ones. We're talking to teams that we call corporate social investors, i.e. corporate foundations, corporate accelerators, or social businesses, or shareholder foundations, or corporate impact funds. And sometimes an organization can have several of those teams within the organization. So how does team differ from CSR? To answer this question, actually, let's step back for a minute. The CSR consideration started 15 years ago. Originally, it was very much about meeting regulatory requirements and risk management, very much offsetting the negative externalities of the business. It is an important role, but not enough, as it's rather a defensive approach to protect the business. So over the past 10 years, actually the European corporates gradually evolved from a focus on risk management towards a focus on the value creation, shown in yellow on the screen, i.e. shifting from a responsive CSR towards strategic and sometimes inclusive business. Why that? Because the corporates have been under two types of pressures. One, external, civil society, regulators, consumers, pushing the corporates, engaging into more societal role, and an internal pressure as well from the employees with the next gen, brands, suppliers, shareholders. And we really saw an acceleration of those trends during the past 5 years. And it is in that context that European corporates started to articulate a true corporate social investment strategy, engaging the organization in the creation of social impact with business relevance. And to implement this strategy, they realized that the most relevant vehicles are those corporate social investors we just mentioned before, whose mission is to create social impact, providing passion capital, investing in high risk, bold, and rather early stage projects. And this is actually what you really need to create social innovation within an organization. So now we move to the next slide, and just to show you the positioning of those corporate social investors and the corporate. As you can see, they are distinct, but actually they can valuably collaborate. The corporate social investors generate the social innovation that the ecosystem needs. It's actually a compass for societal projects for the rest of the organization. And on the other hand, you see the corporates on the right side, driven by profits, having the big advantage of having the scaling capacity. And it's really the combination of the two which makes the collaboration extremely powerful. Now we move to the next slide to show you how the corporate social investors generate this social innovation. Well, as mentioned at the start, they leverage the corporate asset, network, expertise, financial resources, but they also leverage non-financial assets like employees' engagement. And they are bringing credibility and convening power in the social space for the corporate organization. And as you see, it's a mutual benefit because the corporates on the other side, as a result, can strengthen the brand, attract and retain talent with the next gen, which are very much keen to engage in that sector. It also improves the license to operate for the business and can be a source of innovation, increase supply chain efficiency, and you can gain market knowledge. So it's a very much a win-win situation. Now, as you can imagine, in such a context, the corporate foundation practice have changes. And I hand over to Carolina to share some insights. Thank you.
All right, thank you very much, Sophie, and also a big thank you to my colleagues from AVPN for having us. And as Sophie was already saying, indeed, besides a shift amongst companies, we also see a shift amongst corporate social investors in Europe, particularly amongst corporate foundations. In the past, there have been many corporate foundations that pursued the traditional philanthropy approach. So they typically support a wide range of community-relevant issues, mainly through grants. And here, the community's needs are usually the prevailing selection criteria for the grants. But what we see now is that many corporate foundations move towards a venture philanthropy or investing for impact approach. So instead of supporting a wide range of issues, they tend to focus on a few core areas like social sectors or specific SDGs. The following two examples of Trafigura Foundations and Incofin will also highlight how these organizations have shifted their focus on a few key strategic areas. At the same time, there's also been a shift from grant making to tailored financing. So finding the right financial instruments that suits the needs of the investee. So that can include grants, but it may also include debt or equity. So besides the financial support, corporate social investors now also adopt a stronger focus on the non-financial support, like providing strategic advice to an NGO or social entrepreneur. So many corporate foundations and also other corporate social investors in Europe now adopt the venture philanthropy approach. Based on this development, we also three new benefits appearing that really shape the European corporate social investing space, particularly in relation to the company. First, as my colleague Sophie also highlighted, we see that corporate social investors are really ideally positioned to spot transformative social solutions with potential business value. So through their long-term vision, they might see how a new technology or an inclusive business model used to address a local challenge may also help a company to rethink their value chain in the future and build it more around inclusive growth and sustainable growth. Second, companies usually look for innovations that already have a proven and financially self-sustainable business model. They want to have innovations which already yield the shared value between society and for the business. But of course, most of these innovations don't start there. So they begin as a rough idea without probably a sophisticated business model or a prototype to base their successes upon. And especially in these early stages of an innovation, corporate social investors can be an ideal investor to provide seed capital as they have no or only low financial return objectives. And this also leads me to my third and final point, that the corporate social investors can help companies become a pioneer for inclusive and sustainable business. I think we all know that the time for responsive corporate social responsibility is over, and if companies now want to be on the vanguard of pushing further ahead and distinguishing themselves from their competitors, traditional commercial strategies won't be sufficient anymore. And both of the speakers today are great examples of how corporate social investors have helped to pioneer really new inclusive and sustainable business practices that place the needs of society at their core. But to really unlock these benefits, we saw that strategic alignment between a corporate social investor and a company can be one of the primary enabling factors. For those of you amongst you who are now wondering how a company and a corporate social investor can strategically align, I'm afraid I have some bad news, because there is not a straightforward and one-size-fits-all approach. But the good news is that we studied the topic for 9 months with 45 leading practitioners from corporate social investors, from companies, and experts on the field. And we noticed that there are actually 4 different types in which a corporate social investor and a company can align. Those 4 types you can see in the small graphic on the right. If you're interested to know more about which alignment type might be very suitable for you, we're pleased to announce that we are going to launch the results of the study in collaboration with the Stanford Social Innovation Review in the magazine coming out on May 14th. So if you're interested to know more about the topic of strategic alignment and the rise of the corporate social investors here in Europe, and you don't want to miss the release of this article, then please follow EVPA on LinkedIn or on Twitter to stay up to date. Thank you very much.
Thank you very much, Sophie and Caroline. I think your comments frame the conversation for this afternoon very well. It is now my pleasure to introduce our next speaker. Vincent Faber is the Executive Director of the Trafigura Foundation, which leverages the Trafigura Group's expertise in the field of trade and logistics to help achieve positive socio-economic change for people and communities. Vincent, the floor is yours.
Good morning / afternoon, everyone. I see there are 57 attendees, which I think is a great thing. Very successful webinar. Thank you, AVPN, for organizing this. And first and foremost, I do hope that everybody out there is healthy and safe in these circumstances, which are quite special. A reason why actually I hope everything will run out, especially from the technology standpoint, because as many of us, I'm working from home, as you can guess from the background of my video. So yeah, I will present. I will try to stick to the time that was given to us. Present a little bit what Trafigura Foundation is all about, and perhaps explain also how it connects to the company. And why at some stage we thought that it was making sense to get closer and more coherent with what the industry of our founding company, Trafigura, is. So my purpose will be mostly to illustrate why and how we have been undertaking that particular journey, and give a couple of examples, a selected number of partnerships that we are currently running, that I think illustrate what I'm going to explain right now. Perhaps just to give you a glimpse on what Trafigura is, I will not expound here too much, but maybe it's not a name that is familiar to many of you, but Trafigura is a commodity trader. It trades oil products, metals, minerals, and so forth. It's one of the biggest, it's one of the leading 3-4 commodity traders worldwide, and it connects basically supply with demand. You have here a number of figures. I will not expound again, just describing the size of the company and the different groups and subsidiaries it is being made of. Any questions relating to the company, of course, you can go to trafigura.com, as you can see here, and you will have much more and consistent explanations. Looking at our, again, talking of the company here, at the geographical span, you can see that we have 80 offices in 41 countries, which means basically a global footprint, which of course for the foundation is quite it's an asset as well as a challenge, because as a foundation we want to connect to the countries, of course, in which the company operates. And as such, having such a wide geographical footprint is indeed a challenge. And we are definitely not present, because we can't be present as a foundation in all these countries, but we try to connect as much as we can to this geographical footprint. A few figures regarding the foundation. We were created in 2008. So now we are in our 12th year of existence, so rather young foundation, not so young anymore. We have granted last year $8.5 million in grants to our partners, and sometimes in loans or reimbursable grants, shall I say. We work in 26 countries, over 36 programs, and since the outset of the foundation, we have disbursed $67 million. As you can see in the map that you have under your eyes, that we have there too a worldwide footprint. I'm sorry, because I know this is AVPN. Our figure is rather small for Asia. As you can see, 14% of our activities only, but believe me, we are trying hard and we are expanding that figure, which will be increasing pretty soon. So, as I said in the beginning, what has been our history, and how did we kind of move towards getting closer to the company, and why we did this? So we were established in 2007/8. We started our first operation in 2008 as a very traditional grant-making organization, working on 3 pillars, which were education and integration, health and disability, and sustainable development. And then, as you can guess, through these 3 pillars, but basically we were touching a little bit of everything. Not that we were doing it wrong or bad or in an insufficient manner, but it was a little bit too much, or spreading a little bit thin our activities over this whole range of activities. So we thought in 2016, we raised the question, are we really we are making a difference, but are we making the biggest difference we can make? Are we doing the best of all the resources and assets that we have at hand as being a corporate foundation? And the answer was clearly no. So we said it's perhaps time to narrow down our activities, to focus on areas where indeed we can leverage the assets that we have, the networks, the knowledge, the expertise that the company can offer us, and to indeed make greater impact with our partnerships on those areas. So we narrow down to two strategic focuses. One is clean and safe supply chains, which is, as a commodity trader, quite normal, quite logical, and quite natural, because commodity trading is very much about physical trading, moving commodities from point A to point B. And we also focused on fair and sustainable employment, because as a major economic actor, it made a lot of sense. So today we have these two focus areas. We are thinking of a third one because, of course, as you can imagine, as a commodity trader, climate action is an issue that we have to embark on. It's a little bit in the shadow right now with the COVID crisis, but it's still there and it will be there. And it's important that we get on board as well. And along all this, we have also our usual staff engagement activities, which are very normal in a corporate foundation, because it's also part of the focus of a foundation from a corporate background to indeed raise awareness and perhaps expand the overview that people have in the company around social issues. I'm being told that I have 3 more minutes, so I have to go very fast here. So from a foundation, which I will go, indeed, I will let you read this, and I will just say the important facts. The first thing is, early on, we were very independent. We were we had built kind of a firewall almost around us to make sure that our mandate and our mission was not, in those years, as we may have thought in those years, disturbed by, let's say, a corporate agenda, which was not necessarily motivated by pure philanthropy. But we realized over the years that actually this was not necessarily the best choice, and we needed to be more connected and closer to the company, because as a corporate foundation, we can again make a good use of these assets that we have. We can have greater interaction with the business, and we can help, and I think that's the key word, we can help the business develop better practices, good practices, and also we can shed light. We can shed a light on issues that can be embedded at a later stage within corporate practices and the new corporate fields and sectors. I will go very fast. It's always these webinars are so tricky time-wise because time flies in those. I will just give a few snapshots of our key programs. I have here 4 or 5 slides, but I will just expand on 2 that develop very well that what I tried to say. The Smart Freight Center, which is a Dutch-based NGO working on reducing emissions in the freight sector. Of course, that touches a little bit climate action, as I said. And we thought that as a corporate foundation, it was quite interesting for us to help them prototype a methodology to capture, to monitor, and ultimately to reduce the carbon emissions in the freight sector. And from there, from prototyping this methodology in the wider sector of the freight sector, not talking about Trafigura here, but the wider sector of shipping and trucking and freight, then indeed, once it's developed and proved, then we can embed it into the company's practices, good practices internally at Trafigura. And that's, for me, the essence of what we're trying to do. We're indeed starting from a general common purpose, a good, good social purpose from a general standpoint, and then move on, try to move these practices into the daily business of the company to which we are, the company, our founder. So it's the whole idea going from the general to the particular, and I think that's the key role that indeed a corporate foundation can have. In that slide that Caroline presented earlier, this is exactly what industry alignment is. It's not about CSR, it's about indeed joining forces with the company and with the CSR within the company to indeed improve best practices. Another one here in the Republic of the Congo, and I will close with that one, where indeed child labor is an issue. And as a commodity trader also involved in upstream activities such as mining, of course, in many countries, you can all imagine that child labor, for instance, and it's only one example, is a major issue. And artisanal mining is a way of life for many in those countries. So there's two options here. Either you just turn a blind eye to this issue and you ignore it. However, it's still there. It still exists, and it's still kind of jeopardizing your own activities as a company. Or you try to work on those issues with the communities and try to indeed kind of formalize a very informal field of work, which is artisanal mining, so that indeed you can also kind of bring them into your business model. And that's exactly what the foundation has been doing, from really working on child labor, to make it simple, child labor issues in the communities, also try to move the issue to be so that it is embedded again in the activities of the company, so that indeed you do not ignore it, and you do the best out of it, the best for the communities, but also the best for your business, as of course this is a major field in the business of Trafigura. I will stop here. I hope I have been that has given you a good illustration of that journey from indeed a pure, very segregated, independent philanthropy towards something that is more connected to the industry at large, not only Trafigura's industry, but the industry of the commodity trading at large. I just want to conclude on one word, saying this should not compromise the independence of a corporate foundation. Corporate foundation is not, it's enshrined and embedded into the CSR of the company, but it's not the major instrument of the CSR. And philanthropy remains, corporate philanthropy needs to remain driven by the interest of the beneficiaries. So we have to be careful to indeed undertake that journey without jeopardizing and without compromising on the necessary independence that the corporate foundation needs to take. Thank you very much.
Thank you very much, Vincent. And that was a fascinating overview of Trafigura Foundation's activities. I hope we will be able to get into more of your experience during the question and answer session. On to our next speaker. Our second speaker today is Dina Pons, Co-Regional Director for Asia and Impact Manager at Incofin. Dina will speak on the Water Access Acceleration Fund, a joint initiative with Danone to help social entrepreneurs with promising solutions in the water sector. Dina, the floor is yours.
Thank you very much. And good morning, good afternoon, everyone, and thanks to EVP and AVPN for the opportunity to share some of our work here at Incofin and our partnership with Danone. Maybe to set a little bit the context, I would like to briefly introduce Incofin to you. In a nutshell, I would say that Incofin is a global impact investor. What do we mean by that? I think basically 20 years ago, we were created with the true conviction that in order to create a more sustainable and fair economy and society, most likely the welfare state alone, the NGOs and foundations alone will not be able to solve that problem. a very powerful stakeholder that we think can contribute to the creation of this sustainable ecosystem is the private sector. And therefore, our entire work for the past 2 decades has been to raise money from private and public sources, structure them in funds, and then deploy them around the world through what we call impact investments. Our 2 key pillars of investment has traditionally been financial inclusion, as well as agricultural and nutrition. This is where you will see that the water pillar that we're now building is an extension of. We are an asset manager of a size of 1 billion euros. We have already conducted around 1,300 transactions around the world. What does that mean, transaction? It means both providing senior loans to social businesses involved in agriculture, nutrition, financial inclusion, as well as investing in equity in those companies and then becoming a shareholder. And as you can see, traditionally, this is something I will come back on, our base of investors has been a mix of development financial institutions as well as private investors. Over the past 2 decades, I think we have been growing, and I think that growth is showing that there's an increasing recognition that the impact investment is likely going to be one of the most promising way of investing money sustainably in the long run. And as you can see here, the experience of ECOFIN at least has been that while we were originally structuring our own funds, we also have been increasingly over the years, and that's the second line, we've been approached by a number of institutional investors saying, can you actually manage an amount of money that is on my balance sheet? So we've been doing both, structuring 6 proprietary funds, as well as managing 6 advisory mandates over the world. Another aspect I'd like to mention is that the way that we see ourselves as impact investor is summarized by the concept of capital plus. What do we mean by that? I think our experience has been that channeling capital over the world to institutions in need of funding is a needed thing. However, one thing that has proven the key to success is, in addition to this capital, to provide technical assistance, to provide hands-on board participation, governance enhancements contribution. And therefore, to the extent we can, each time we structure a fund, we try to structure also a technical assistance facility next to it. And currently, we've been able to mobilize around 11 million euros of grant funding that we each time structure in a specific technical assistance plan that will be catered to the need of a specific investee around the world. One thing that, looking back again at almost 2 decades of work, I think when we look at the components of where is the money of impact investing coming from, as I said, we traditionally have been seeing more pension funds, more development financial institutions, more banks coming to us and say, hey, can we try to find a partnership for you to channel our money meaningfully? We have seen fewer cases of corporation joining that battle. And I think the Gini report does show that, for instance, the total out of the total amount of impact investing money out there, only 2% is coming from the corporation. I think, linked to the very topic of our discussion today, we think that corporations have an enormous and extremely meaningful role to play. Why? Because maybe contrary to the investors that are one step further upper in the whole ladder of funding, the corporation has actually both the capacity to have the funding, the scale, as you said earlier, but also has been very much exposed to the real economy. This is a corporation that has fixed operational problems, that knows what are human resources issues, and that dual kind of identity is making them extremely relevant partners when it comes to then deciding an investment strategy in the impact space. You see here a little bit again, where is our funding coming from? And as I said, well, the 2 first lines show the core of our investment base, which are development financial institutions. You might recognize some names of the big DFIs from Europe, FMO, BIO, Proparco, to name only a few, but also private institutional investors, pension funds, and banks. We have seen over the years an increasing number of foundations and corporations also slowly showing trust and interest in partnering with us and in using our impact investment expertise. The latest one that I'd like to focus the rest of this presentation on is Danone, and the recent partnership that we are co-creating together, and which is related indeed to the structuring of a fund, an equity fund that will be focused on accelerating access to drinkable water. I think if we take a step back and we, we with our Ecofin eyes look at Danone, I think for us, we thought when we started talking about setting up this fund together, I think it was very clear to us that impact was not a new topic in the corporate culture of Danone. Most of you must be familiar, obviously, with the concept of social business that was executed through a partnership between Danone and Mohamed Yunus, of course, in Bangladesh. But there have been also many other initiatives that Danone has been involved in, both at the heart of their own business model. So, for instance, the WeActForWater initiative is really trying to look at how to reduce virgin plastic use. It's also really trying to push for initiatives that will increase the number of the affiliates that we go for a B Corp certification. So this was a clear thing that we could witness in their history of having approached the concept of not only social responsibility but social impact. More specifically, as far as what was the relevant expertise that helped us build this partnership, I think Danone has set up for some years now what is called the Danone Communities. Danone Communities is basically a fund which is mostly relying on funding from its employees. And that is providing patient capital to innovative social enterprises around the world. This social business basically that are trying to fix a problem related to access to nutrition or to access to safe water for that matter. So there was overall an understanding that yes, corporate culture-wise we would fit and we could work together, and I think this is kind of the key takeaways that I think I want to highlight as far as what could be the things to watch out for, to really dig and investigate when people from different worlds, when corporation and impact investor, which is our case, try to meet and do something together. The fund that we are then talking about, what will be Danone's role in it? Danone will simply be the sponsor investor, and I think what's quite revolutionary, I would say, for that matter, for that concept, is that we are experts in impact investments, but we're not experts in water. And meanwhile, Danone is experts in water, but recognizing that building to a broader scale than their current Danone Communities investments, a strategy around accelerating access to drinking water around the world, they cannot do it alone. They will need that impact investment expertise, and I think that's where we met. So therefore, very simply, Danone plays the role of the catalytic investor, because they help us be able to say when we are now in an advanced stage of fundraising, to say we already have a first sponsor investor. They are committed to put 10 million euro on the table, and they are committed to support even through a first loss tranche in the structure of the fund. And I think these are two very powerful key components when you start engaging in fundraising, of course, to show that you have a trusted partner that has the technical skills, that is making the financial commitment, and that is taking a little bit more risk than likely the other investors. In a nutshell, just to give you maybe a bit more perspective on what is this fund about, I think, why water? I think the issue of access to drinking water around the world is something that likely we are all very familiar with and can only witness how worsening the trend is likely to be. Therefore, the purpose of this fund will be to invest minority stakes. So again, it's an equity fund in social businesses that are trying indeed to solve this drinking water access. We will focus on three key types of businesses: water kiosk, small water pipe, as well as water technology companies. And we'll try through taking those minority positions to, as I said, be this capital plus, put in place this capital plus approach, be that co-pilot for these businesses, which for most of them or a lot of them are typically locally promoted. So these are like-minded, talented entrepreneurs that set up something but unable to take their business to the next level because of funding difficulty, because of technical difficulty, because of scale difficulties. So we want to be that partner for them. The fund will therefore obviously be linked to the UN SDG number 6 on access to clean water and sanitation. But I think beyond that, providing clean access to water is having a multi-dimensional positive impact. It is recognized that in many cases, when the water needs to be fetched, women are told to actually perform that task. It is also seen that when people boil it, they inhale fume, and their, of course, health is being impacted, but also the CO2 emission linked to that, if it's done at high scale, is an issue. And of course, if you don't have to spend time looking for the water, boiling it, then you're more likely to have more time to allocate for economic activities. So these are, the type of impact objectives that we hope that fund will contribute to. Again, as an impact asset manager, what we are now doing is very much using the existing systems that we have at Incofin and deploy them, adapt them to the investment basis of water. Therefore, we already have impact measurement tools. They will need to be fine-tuned, and we'll aim through that process to therefore raise 50 million euro to make 10 to 12 investments and to have therefore average ticket size of 3 to 5 million depending on the need of these institutions. So if I would like, if I want to take just 2 more minutes to kind of conclude, I would say what do we think are the key strengths of this partnership, and what could be the humble takeaways that we would like to share with the audience here for this conversation. I think the first point is what I was mentioning earlier, is the alignment on social mission. Yes, we're coming from 2 very different ecosystems, corporate and impact investor are different. They have a different story, they speak a different language, but aligning on the core idea of what impact we want to have and what basic social mission we want to accomplish together, I think is one of the key things that enables to maintain the relationship and the understanding, even when there are times that we need to actually clarify where we're coming from in our diverging opinions. The second aspect is to recognize our complementary expertise. We are the global impact asset manager, and Danone comes with the global expertise on water and with their own experience on having specifically invested in a number of small social businesses around the world already. So again, here, really trying to learn from each other, take time to speak the same language and to respect each other's expertise has proven to be the key to success to be able to move a partnership of that sort forward. And the final aspect, I think, is the idea of local presence. I think none of us could claim to have a global impact investment strategy without having local presence, without having people based in the countries where we actually invest. And both for Incofin and Danone, we can benefit from a wide range of offices around the world of existing investees. And I think this is also what can make the partnership successful. Once we invest, again, we will need to rely on hands-on board members, on technical assistance providers, and being able to find people who can understand the local cultures and realities will be, of course, extremely key. And this concludes this brief presentation. I'm happy to the floor back and answer any question you may have. Thank you.
Thank you very much, Dina. We have now reached the Q&A portion of the webinar. Please enter your question in the box that you see in the bottom right-hand corner of your screen. Please note that you will not be able to see all the submitted questions. Rest assured that we are monitoring this behind the scenes and will address as many questions as possible. May I invite all the speakers to please turn on your webcams and come on the screen. Thank you. Great. So the first question I think, Vincent, this goes to you. In developing a social mission for Trafigura, how did the group enable buy-in from all parts of the business?
That's a very good question and actually a pretty complicated one. I would challenge the initial part of the question in the sense that I'm not sure the foundation has really designed the social mission or the social part of Trafigura's activities, and that's the difference I was trying to make between corporate philanthropy and CSR. Whereas one philanthropy is driven really by what I see as the main motivation is the beneficiaries. We are trying to make impact on the beneficiaries' lives and context and livelihoods, because that's the mission we kind of given ourselves at the outset. CSR is working on similar issues and with similar partners and instruments. However, the motivation is slightly different in the sense that it's driven by a business interest, and there's nothing wrong in this. It's just, managing your license to operate. It's often, like in many countries, in India, for instance, but also elsewhere, it's an obligation to get your license to operate. So the CSR is more the one designing, let's say, the social part of the social component of the business activities. However, as a corporate foundation, philanthropist, and because indeed we have decided to work on fields where the company gives assets to us in our own mission, philanthropic mission, because they have the right expertise, because they have the right networks. We can help them, we can shed light on issues, social issues, like, for instance, in that tax example I've been giving earlier, on child labor issues, and then they can bring that along in their own business practices. So it's more kind of inspiring them or shedding a light, again, on social issues. It's the same with East One. I didn't mention that one in my example, but it's working on seafarers' welfare. And seafarers is a very vulnerable group of people. You can see it right now in the news with the COVID, where you have crews that are stranded at sea, that are not allowed to disembark. And that, of course, gives a lot of stress, a lot of anxiety, a lot of exhaustion to many crews around the world. And they are often from, rather underprivileged or disadvantaged backgrounds. So this is a population which is a little bit under the radar, but for which there's a lot to do in terms of social support. And in that respect, by working with East One, a British NGO charity specialized on those issues, by working with them on helping that particular community, we can also help our company develop good practices in terms of providing better care and better attention to that particular workforce. So it's not really that we design the social mission, the social part or the social component of the activities of the company, but we give some inspiration and we make connections with particular partners, which can then work directly with the company in designing social solutions in the business practices. I hope that answers the question.
Thank you, Vincent. That's a very thorough answer. A question for Dina. Are there any constraints about which programs can be moved to impact investing? Some programs might need patient funding for a long time before impact can be seen.
Mm-hmm. Yes, I think so. Our core investment focus in financial inclusion and agriculture has been growth capital investments. So I think, given the type of asset owners that invest in our funds, the type of returns that they want, the investment period that they are keen to keep their liquidity blocked for us, I think it would be irresponsible of us to claim that we could finance, greenfield or pilot testing phase type of businesses. So for us, we feel that indeed we are coming at kind of the second phase of the growth of the company, when there's been a business model that is starting to prove itself. The company might not yet be profitable, but there's clearly in the ground something that is being able to work and to somehow be scaled. And we come as the first generation of institutional investors, so the ones that help now, typically, institutions that were previously funded by grant funding or local money, and we try through our, again, capital plus approach to take them to the next level. Of course, in financial inclusion, the growth concept has been able to be proven in the agricultural sector, where we also invest. There are certain business models. We finance producer organizations. We finance a lot of agri-businesses in India. And here again, we do find that there are businesses that can find their scale. But again, all of these, realities have to be taken very cautiously. And we always want to be very clear that we don't want to raise money from sources of people that are then going to push us to reach a certain return or a certain size or a certain money multiple that we cannot get given the essentials of the business model that we finance.
Thank you very much. Sophie and Caro, there is a question around the policy restrictions for the use of CSR funds for impact investing. Do you know how various European companies have addressed or overcome policy restrictions?
Yes, actually this proves that the practice of corporate philanthropy and impact investing with a corporate organization is always tricky, and not only, by the way, in the corporate organization context. Just because typically a country like France or Germany would not, as a corporate foundation would not be entitled to practice impact investing, i.e. investing through equity or debt. The only financial instrument available for them would be grant making. So actually, it's difficult to have one single answer to this question, and the answer I can provide is really that kind of a pragmatic answer. When there is a will, there is a way. And when an organization wants to step into impact investing practices, then they create an appropriate vehicle, which is always possible in I would say in all kind of regulation and legal context. But it needs to be an appropriate vehicle, and it might not be the same one in Germany, in France, in India, and in Bangladesh. Okay, so I'm sorry I don't have a really straightforward answer, one fits all. It's really case by case in countries.
Thank you, Sophie.
Thank you.
Unfortunately, that's all the time we have for questions in today's session. If you have any questions that were not answered today, please reach out to us at knowledge@avpn.asia, and we would be happy to follow up with the speakers. Thank you very much to all our speakers. I would now like to hand over the mic to Kevin for some closing remarks.
Great. So thanks again to our partners at EVPA, Sophie and Caroline, and our panelists, Vincent and Dina, for their amazing insights into corporate social investing in today's webinar. Moving forward, as Roche has mentioned, please send us an email in case you have further inquiries about what has been discussed today, or if you would like to know more about AVPN. We will be putting up a screen with some survey questions for you, so please do respond to that and let us know what your feedback is around this topic, as well as what we can improve for future sessions. This webinar is the first, but by no means the last of a series that we plan to conduct on corporate social investing. The next session will take place at the AVPN virtual conference. And on that note, the virtual conference will be going 100% virtual this year as many of you would have received the update, and we are taking the power of networks to a new level with a 5-day program running across the 5th to the 12th of June. Now in its 8th year, the AVPN conference will explore themes such as gender, climate action, nutrition, and health, with a special segment on COVID-19 that highlights best practices from early actors who have made a tangible difference in these past months. We will also focus quite a bit on the topic of collaboration across the days and highlight the community effect to respond to not only COVID, but all these other pressing issues confronting us in Asia and beyond. Please check out our conference website. You will find it at https://conference.avpn.asia. So that's conference.avpn.asia for further details, and do register for a ticket. Thank you once again for joining us today, and we look forward to seeing you at our next event.
Thank you everyone for joining us. We hope you enjoyed the session. Please share your feedback with us on the poll that you see on your screen right now.